All right, to help break this all down, we're going to get a little help here from Thomas Hayes, founder, chairman, managing member of the Great Hill Capital. Good to see you, sir. And I don't even know where to begin. We got punched in the face, then we got punched in the stomach, and the market's still standing, kind of, I guess. What's your thoughts?
Well, there's no question the inflation numbers on Friday were an absolute disaster. You mentioned energy up 34.6%. I mean, part of that is the domestic policy. Part of it is the West has decided to finance the defense of the Ukraine at the gas pump, and it's hurting everyone. And it's a conscious decision, but it's having consequences. And inflation is up across the board, as I said. However, there may be some relief in sight, and I'm looking forward to the PPI report, the Producer Price Index report, tomorrow morning, Phil.
Right, and so for those that are watching this, the wholesale numbers, not just the retail numbers. 6 months ago, the Federal Reserve said we're in transitory. In other words, they thought inflation was just going to go away. Now, I know things change. We had the conflict in Ukraine, and we have more supply chain issues. But did the Fed make a really big mistake?
Well, the challenge they have is some of it is completely outside of their control. They can't affect energy policy in the United States. We have unlimited energy. We've seen the ability for us to be self-sufficient in terms of energy. That policy has changed. It's put us in a vulnerable position. This is the result of that. The other thing is they can't control the supply chain production. And the good news is 1/3 of inflation is the result of new and used car prices. That's attributable to the semiconductor shortage. Adam Jonas of Morgan Stanley put out a note last week basically calling for the end of the semiconductor shortage for autos. His team on the ground in China is showing that Taiwan Semiconductor, which has 50% of the chip market, auto chip market, their production is up 60% year on year despite the shutdowns. If that's true, that's going to be huge because used car prices are up 60% over the last 2 years.
I mean, isn't that crazy? I mean, just saying it sounds crazy to me. Like used, I mean, I'm sure our friend George is going to be happy because then they can buy a car and they don't have to pay these ridiculous prices. I want to get to both housing and I want to get to what the Fed is going to do next, because earlier today we were talking about this 50 basis points or 75. I'm not sure it really matters because we're already talking about July and then being behind the 8 ball. But you said there might be some good news from the PPI. So how do we balance the two?
Yeah, well, I think this is going to really make a difference to what they do on Wednesday, because there are 3 factors. Number one, PC DRAM, which is a bellwether for semiconductors, that's down 14% since mid-2021. The Drewry index on shipping containers, that's down 26% since September 2021. And North American fertilizer prices are down 24% from March, which was an all-time high. So, PPI leads CPI. So if the PPI numbers come in lower than expected, the Fed can point to that and say, look, the numbers we're looking at are showing that inflation is coming down. It will show up on a lagged basis in the supermarket, at the pump, et cetera. As such, we're going to stick with 50-50-50 or something along those lines. If PPI fails tomorrow morning, I think they've got to go forward and they got to say, listen, we guided 50 and 50 in July. We're going to pull forward July. We've got to get ahead of the curve. Maybe we won't do any in July, but we're going 75 or 100 right now. So they've got to retake control of the narrative if those PPI numbers are not better than expected.
The headlines over the past couple of months has had a psychological impact on investors, a psychological impact on workers. We see lots of companies now have hiring freezes. Is that a psychological impact on spenders? Everybody here that's watching this in the control room, like people are cutting back on eating out. People are cutting back on vacations. People are cutting back on driving. And this has all been proven in all the surveys that's been done.
Yeah.
Is that enough for the Fed to say, look, we scared people enough so people are going to slow down their spending?
Well, the problem is policy works on a lagged basis. So the stock market is getting anxious and saying, ramp up the hikes, let's get inflation under control. But to your point, their jawboning has done a tremendous amount to slow demand and slow growth. You saw consumer confidence on Friday down below the great financial crisis levels. That was a whole different story. Right now, the consumer still has quite a bit of savings left over from the stimulus check, over $1 trillion.
Speak for yourself.
They have more money in savings than they had pre-pandemic. That may run out over the next 6 to 9 to 12 months. There's no question about it. But if you look at S&P earnings guidance, as pessimistic as everyone has been, they are passing through that inflation because estimates continue to go up. Last week alone, the 2023 estimates for the S&P were at 251.34, which means we're only trading at 15 times next year's earnings compared to the last 5-year average of 18.6 times, which includes the last tightening cycle. So I think that, maybe we're a little overdone. We do need to see some green shoots. There were no green shoots on Friday. Hopefully we'll see some tomorrow.
Very quickly, one of our good friends here, we were talking about commercial real estate and residential real estate. There's no way that you have mortgage rates skyrocketing the way they have and not have an adverse impact on commercial real estate and residential real estate. Do both of those have to pull back significantly?
Well, it's commercial real estate is valued on the basis of cash flows. So the cap rates have been compressed. Rents are going to go up. So I could definitely see a leveling off in prices, maybe a modest pullback, but we're not going to see anything like 2006 to 2008 where prices actually dramatically reversed. I don't think we're going to see anything like that on the commercial side. On the residential side, pulling back demand is probably not a horrible thing since we're so far behind on supply, and that'll keep prices a bit normalized.
Real quick, 50 basis points or 75 this week?
Depends on the PPI tomorrow morning, but I'm going to go with 50 and some strong jawboning guidance. How about that?
Oh, boy. Thomas Hayes, thank you very much. Chairman and Managing Member of the Great Hill Capital. Great to see you. Thank you for that analysis.